Great. So allow me to welcome everyone. My name is Chris, and I'll be hosting this session. This is, in fact, our very first webinar, and I'm quite excited to see how we're doing. So you can, of course, watch this webinar here. We'll make it available on YouTube as soon as we're finished. And you can also download all the slides, the tools, the videos themselves as we post it on our website immediately after. There's also quite a bit of free stuff you can download, and as we go through the webinar today, you'll see us discuss some of our tools. We'll refer back to some of our how-to guidebooks. And I think for those of you who either has been working with us or at least been hearing some of our keynotes, you'll find that we've been upgrading strategy tools, our research project, quite a bit. So if you're interested, as we proceed, you should be able to find a lot of interesting stuff and tools available at strategytools.io. It's, of course, our open source platform. Now, I hope that many of you want to join the conversation. It is our first webinar, but we want to talk with you just as much as we talk to you. And I think we just have our first guest from Malaysia giving us a quick feedback on the strategy tools, and thank you, Roslyn. Very appreciated. So the chat is working. We're also active, of course, on Twitter and Instagram. And although you can't see her, just next to me is our amazing colleague Jolene, who's kind of making everything work in the background. So my name is Christian Rangen. I've, for the past 15 years, been working in the field of advisory and teaching research. So for the last 7 years, I've been busy building Engage Innovate, which is our strategy and innovation consulting company, as well as doing the groundwork and the research for strategy tools. And I think that what's really important to us is the ability to have an academic foundation, but design simple, easy to use tools that people can put to work within their own context. Sometimes those tools are completely generic, and sometimes those tools are quite customized. And if you go online, you can find a few examples of the customized tools that we're able to share. Some of you probably know this, but for those of you just tuning in, we are, of course, located in Norway. And although that's not personally me in the photo, this could easily be me or some of our refreshing clients. This is what our local beach looked like just a few weeks ago. And this is what our local highway looked like a few weeks ago. And we do offer some pretty interesting team building exercises where we'll teach you strategy tools and we'll teach you skiing as well, but that's a different story. So quick introduction to us. We are a strategy and innovation consulting company, and we really partner with clients in different fields. We work extensively with CEOs, we work with strategy and innovation teams, and we also work a lot with the innovation side, the innovation lab, the new ventures, the new business development sides. And we're quite fortunate to have projects and clients almost all the way around the world. We now have projects towards the Middle East, Sri Lanka, Malaysia, some things happening in Europe, and our work has really allowed us some interesting clients. Right now we're doing a project with PwC, business model innovation. We're working with Malaysian, German, quite a range of clients that we're happy to had a chance to work with over the last couple of years. One case that I'm going to refer to slightly, and that I think is really worth following from the outside, is of course the ongoing transformation of Statoil. There's a lot of things happening in the oil and gas industry, and Statoil is one of those companies who's really investing in the future and kind of investing outside of the traditional oil and gas areas. We're going to come back to that in a little bit. We have, over the last couple of years, focused a lot on how do companies do faster innovation. And although I'll be not speaking a lot about these today, you're going to see me come into some of the examples around mobility, electric vehicles, and also clean energy projects. Now, just before we kick off our main topic for today, it's just a fun fact. So the broadcast and the webinar you're hearing today, that was actually written in Brazil. The slides were developed in Malaysia, and the recording itself that you're hearing right now was done, or is being done, in Norway. So that's the fun fact for today. All right, so let's dive into this, the 5 strategy traps for 2018, and of course, how to solve them. So the 5 strategy traps is really work that we've seen probably over the last 2 or 3 years. And I think that many of you listening in today have seen the same. So this was an article that we wrote actually January 1st this year. And it sums up some of the experiences and also definitely the challenges that we've been facing over the last couple of years working with clients. My goal today is really to shed some light on these, to help you potentially navigate or at least be aware of these, but really also to get some discussion and interaction from you guys. The 5 strategy traps that we've identified is, number 1, the board. Number 2, resource allocations. Number 3, the lack of time, interest for innovation. Number 4, the shifting landscape. And then number 5, and I think maybe this is the most important one, do we only have just one strategy, or do we have multiple strategies? And we'll get into that a little bit later. So those are the 5 traps. And since we published this, we have been getting hundreds, and I literally mean hundreds, of feedback, question, comments, a lot of traffic on our LinkedIn article, quite a number of articles being shared and commented on. Fun fact, our biggest group of readers come from South Africa. Our second biggest group of readers come from Southeast Asia. So I think the topics that we're discussing today are applicable for most leaders in most companies, in most cultures. And I hope that you'll agree with us as we move on. So strategy trap number 1 is the board. And really, it's a board that frequently say, yes, we want new ideas, and yes, we want new business development. We want to explore new growth opportunities, but in reality, all they want is maintain the status quo. And we have seen this by working with our clients, that as soon as you step into the boardroom, something happens to the dynamics, something changes. Formalities, positioning, lack of insights. We've been trying to understand this. And one thing that we frequently ask in our projects working with clients is, do you actually understand the board? I mean, do you really deeply know what they care about? And do you really deeply know what they focus on? And I just want to take a minute here and ask you guys a question. Based on where you're sitting, whether you're in Norway, whether you're in Malaysia, whether you're in mainland Central Europe, do you really understand the board? Let's hear what you guys say for a second. Good. So I'm going to give you a few examples of the opposite. One thing that we frequently hear working with innovation leaders and strategy leaders is that they prepare for a big board meeting. They practice. They do the legwork, they do the groundwork, they do the analysis, and then they prepare for a, let's call it a big presentation. They might say stuff like, hey, we have some surprises in store. We have some exciting news in store. They might say, the board is going to be really excited about this. But very few of them realize they're actually walking into, let's call it almost an ambush. What we have really come to accept is never drop any news, never drop any bombs, or even just halfway radical ideas on the board in one session. Unless you've prepared them in advance, unless you've really gotten them engaged, had the discussions, had the interactions, you're really running a high-risk sport. Do not drop bombs of radical ideas in a board session, in the boardroom. So how do you avoid this? Well, what our thinking and also our recommendation on this is, think of the board members as your business partners, not as your sort of higher decision makers. Think of the board members as joining you on a learning journey. You have to. You really, really have to take them along for the same understanding of the shifting landscape, what we call industry shifts. You have to involve them, question them, put them in a delicate but a comfortable position, and make sure that they get involved in your process rather than just exposed to whatever you're presenting them to. Now, this can be challenging, and we're just getting a comment that we might have to go through management. We might have to go through CEO. We might have to go through EVPs or even VPs. And many innovation teams or strategy teams will say, "Oh, we don't have access to the board." And that's quite common. Well, in our experience is, if you have a good enough reason to, you will frequently get access to the board. Either invite them in for a workshop, either invite them in for kind of a creative half-day session, or take them out for dinner, take them out for lunch. Find different ways of engaging with them. And actually, interestingly enough, in the most recent Harvard Business Review, there's a great article on the role of the chair of the board, where the article speaks about the importance of connecting the operational side of new business development to the management side of the board. So I think this is a trend that we're seeing is, don't report to the board, but engage the board and involve them. Strategy trap number 2. So number 1 is the board. How do you get the board involved? Once you pass that, once you sort of clear that hurdle, it's really down to something as boring, something as mundane, but we feel something as critically important as resource allocation process management. And we hear a lot of companies discussing the needs, discussing the ambition, discussing the desire for, we want to explore new growth areas, we want to invest in new projects, we want to have an innovation lab, we want to have a corporate venture arm, but we don't have a budget for it, we don't have the people for it, and we definitely do not have a willingness to shift assets. So you can forget about that. Well, those are challenging. And one thing I'd like to ask you guys in our chat box is really, how do you allocate resources to old projects and new projects today? So if any of you have any experiences or any ideas on that, I'll be really interested to hearing your views now. How are resources allocated today? Because one thing that we've come across mostly in the last 2 years is that we ask that question to senior people either on the strategy side, the new business development side, or on the innovation side. They can't really answer. They don't really know. Either they don't have access, or most likely they never really focused on how does the annualized or even quarterly resource allocation happen today? So a question that we frequently bring up in discussions with our clients is, okay, so you want to develop new areas? Well, how do you shape resource allocation? So we have one here. Wayne Fox is actually tipping in. He says, in our company, 10% of annual profits go to innovation and new development. So that's one way. And this is a great way, Wayne, of having a structured approach to resource allocation versus a more randomized approach to resource allocation. I know there are very different ways of approaching this, but I'm sometimes baffled. I'm going to share with you a story from actually just recently. So a company that we just started working with, when we started working with the innovation team and the new business development team, they were all about ideas. They talked about ID competition, brainstorming sessions, ID portals, online platforms for developing new ideas from diverse employees. And all they spoke about was the idea management. Problem was, all management talked about was this. Management was all about, well, what's your ROI? What's your cash flow analysis? What's the financial risk? How detailed is your spreadsheet analysis? And quite quickly we realized there's such a big discrepancy between the idea management and what management cared about for resource allocation. So the big question in terms of resource allocation is, how are you able to connect the business outcome and the ROI to the resources allocated? And this is nothing new. Our dear friend Rita McGrath over at Columbia has been saying this for a long time, that innovation has very little to do with new ideas and creativity. And it has everything to do with how the organization works, how the system works, and how resources are allocated. So one thing that I'd like to just kind of put out there is how do you build a resource allocation return case for top management? Not necessarily a traditional ROI, but somehow connecting this. And I'll give you one example. So the energy company Statoil recently launched what is basically one of the world's largest clean energy funds. They have allocated 200 million US to invest in emerging technologies, emerging business models around clean energy. Now, a lot of companies would say, like, oh, you're spending 200 million on very risky investment. That's a pretty poor way of looking at it. What they're actually doing is they're expecting 2.5 times return. That's a number that they've developed internally. That's a number that makes sense for them. And that's a number that now allows them to say, now we're investing 200 million here, and we expect 500 million back. So the return case on that resource allocation of 200 million is very, very strong, and it's widely shared across the innovation management and the investment management teams. Those kind of hard facts return cases is something that we don't see very often, because we see a lot of focus on the ideas and the ideas. Now, the third strategy trap that we see, and I'm pretty convinced that many of you guys see the same thing, maybe a little bit too often, is that we don't have time for innovation. It's like, yes, we want it, top management asks for it, the board asks for it up to a point, but we have no time, we have no commitment, and we maybe even have no interest to build a coherent end-to-end innovation strategy. And this is something that's been more and more common over the last couple of years. And Rita McGrath and Steve Blank recently held a workshop on this in New York where they discussed the innovation theater. Companies will put on their theatrics, they'll recruit an innovation director, they'll put up an innovation lab, they'll do some marketing and some social media stunts, and they'll pretend. But in reality, there's very little substance and structure behind it. And our friends over at CB Insights recently presented some of the most classical ways of dressing up for innovation. And I picked up two for you that you probably can see on your screen. So one of the easiest way of dressing up for innovation is, well, you hire a chef, because all of you know that Google has free food and they have excellent chefs. So surely there must be a correlation between the quality of the food and the quality of the innovation. Well, maybe not. Equally, you have, let's just put up an accelerator something. We'll call it an innovation lab, we'll call it innovation sprint. As long as we do something, we should be covered. Well, not quite. What we would like to introduce you to is a much more holistic view, a much more solid view. We call it the MIS, or the minimum innovation strategy. So building a minimum innovation strategy is something that we've now done with several companies over the last couple of months. And we're going to dive into this tool more in depth at the end, towards the second half of this webinar. If you're really curious and you're really sort of quick, you can download the how-to booklet. It's available for free on Strategy Tools and also on our website. But we're going to come back to this a little bit later. So the fourth strategy trap that we see is, we call it rinse and repeat in the face of a shifting landscape. Something that we've seen is that as the pace of global innovation picks up and goes faster and faster, the speed and the dynamics of innovation is becoming more and more agile, faster, and also more challenging. So many companies, they will actually basically rinse and repeat the same market analysis, the same competitor analysis as they've been doing the previous couple of years. But I want to show you a case that we've been working on. So this, of course, is a train. Who are the biggest competitors for a train today and tomorrow? Who are the biggest competitors for trains today and tomorrow? By traditional competition and traditional analysis, we would say, well, of course, there are other train companies. And up to a point, yes, other train companies can be. What this company is starting to realize is that trucks are relevant, planes are relevant, but it's the long-term implications of self-driving cars, here pictured with the Google Waymo car, that is really going to drive this new competitive landscape. Equally is the rise of software. And for those of you maybe not familiar with this, mobility as a service, or MaaS, is a fairly new software solution where you have software that covers all modes of transportation into one single app. So instead of the user having to choose, should I go on the train, should I go on the tram, should I go on a boat, should I go on a plane, the app will decide for you. And what happens, of course, is that the app owns the customer data. The app owns the customer relationship. The app and the provider behind the app owns the data and the analysis that allows them to develop new services. And this is happening already. Interestingly, the Norwegian Railway NSB, recently purchased trains worth of 4 billion NOK. While these things are also happening. And the interesting question in a shifting landscape is really, should you continue to invest in your core legacy assets, or should you be investing aggressively in new areas? And what we are starting to map out right now is that in the space of autonomous mobility, in the space of smart and connected cars, you're basically having a perfect convergence, a perfect storm between technology companies, in this case Intel, software companies like Google, car manufacturers, and also what we call car disruptors. The picture you see right here, Blue Sky Thinking, is a Chinese startup called NIO. They are probably one of the best funded startups in the world, mostly by Chinese investors. They have been able to handpick premium technology leaders from different fields, notably from Cisco, and they're now reimagining the car. As you can see in this picture, this is basically the car without the steering function at all. This car is built as a technology platform. Now, these are the kind of competitive threats that are happening, where it's really, really challenging to remain a train company, to remain a rail company. So the question that we often bring is, all right, do you know who your competitors are? And most companies will say yes, of course we do. More interesting is, do you know who your future and very possibly your unlikely competitors are? Do you know which companies and competitors that are not relevant today, but very quickly could be tomorrow? Because if you follow the logic behind a shifting landscape, you shouldn't really be tracking the competitors you have today. You should be tracking the likely disruptors that's just on the horizon, the ones that doesn't make sense. And very, very importantly, because we've seen over and over again that once these emerging competitors get to a certain stage, by the time you realize it, it's almost too late. I was in Malaysia last week, and I asked a question to a senior group of business leaders from oil and gas, from energy, from infrastructure, from construction, from technology. When did you consider buying Grab? And we followed up by which time was it too late to buy a company like Grab? And Grab, of course, being extremely high priced, much like Uber in the Western markets. And the discussion kind of centered on, by the time they had realized that it was something worth looking into, Grab was already so expensive and so highly priced that it wasn't really an option anymore. So the fourth strategy trap is really, if you stay too focused on your existing competitors, if you stay too focused on your existing industry landscape, you're going to miss the opportunities and the threats that are coming up. Now, the fifth, and probably the most important and the most relevant, is, wow, do you only have just one strategy? And some of the CEOs I've been speaking with recently, they find this kind of perplexing because, of course, they have one. Of course, they have one strategy. Now, what we mean by this, and just like our friends at Innosight suggest with this idea of dual transformation, where you need a transformation around your core business, but you also need a transformation around your emerging business opportunities, is if you fundamentally believe that your landscape and your environment is changing, well, then probably you need to pursue multiple strategies and multiple business models, probably in parallel. And this is where it gets complex. It becomes very challenging for most companies to operate, because you have to do many things, many quite different things, equally well at the same time. I'm going to give you a few examples of this. So one of my personal favorites that we haven't worked on, but I follow very closely, is Volkswagen's work around Transform 2025. And Transform 2025 is probably the biggest, most disruptive shift Volkswagen has ever done. I'm going to share with you 2 slides. This first slide is how Volkswagen see their industry changing. Just take a moment to look at this before I get into it. So this shows how Volkswagen sees their own industry changing. And on the left-hand side, it says product innovation. And what Volkswagen means by that is, traditionally they have been optimizing product innovation, meaning slightly better engines, slightly better cars, what most companies would call incremental innovation. Now, in terms of the product innovation, meaning the car in itself, they're now looking at more, they call it novel innovation. Cars are going to be autonomous, of course. They're going to be electric, of course. And they're going to be connected in an intelligent system thinking solution. Now, this is what Volkswagen calls the product innovation. What they're really focusing on, though, is this other area that they call business model innovation. Traditional business models for the car manufacturer is you produce it in the factory, you ship it to the car dealership, and then you sell it in a transactional deal with some car financing on top. What's happening now is Volkswagen is starting to get into what they call, and this is big for a German manufacturing company, revolutionary business model innovation. Revolutionary business model innovation for Volkswagen basically means sharing mobility, unconventional and conventional drive systems, and really rethinking how cars are used, sold, and operated. Now, where it gets really interesting and where Volkswagen is really trying to push themselves is what happens when you combine the product innovation and the business model innovation. And that puts you up in the upper right hand where it says advanced mobility solutions. Volkswagen today is actively looking into robot taxis. They're actively looking into intelligent autonomous fleets of cars. And they're seeing this industry shift happen at a much faster pace than they expected just a few years ago. So how do they respond to this? How do they, as a big traditional German manufacturing company, respond to this? Well, the Transform 2025 strategy is quite simple. It has 4 building blocks. Number 1, transforming the core business, efficiency, operations, cost cutting. Number 2, build mobility solutions. This is basically a brand new business unit that has the potential to become bigger than the car manufacturing itself. They need to secure significant funding from the outside. And all this lies on top of strengthening their innovation power. Hidden kind of deep in their slides is a very interesting statement, again, for an industrial manufacturing company. Volkswagen is now investing billions of euros into becoming the world market leader in e-mobility and develop the mobility industry's strongest digital ecosystem. This puts them right into the fight with the likes of Uber, Grab, Digi in China, and companies that they traditionally, just a few years ago, didn't really pay attention to. So how does most companies do this? How does a consulting company, a construction company, a utility company, oil and gas company, how does a company do this in practice? Well, what we suggest is kind of thinking in 3 steps. Steps number 1, you have to understand your legacy core business and almost leave it be. You can fix it, you can tune it, but you shouldn't be expecting too much. You shouldn't expect disruptive innovation to come out of the core business. You shouldn't expect radical new ideas and a overnight success in terms of creating an innovation culture. You should leave your core business pretty much the way it is. Optimize it, change it, tune it, do cost cutting, do efficiency, but leave it as a fairly linear cash generating business. But what you should do is understand the growth businesses. What are some of the potential growth businesses that should be spun out, kind of put to the side? Give it different people, give it slightly different skill sets. You might have very different business models. It might be linked back to your core business, but it should be a different business unto itself. Now, the strategy in this area should really be about growing in new markets, growing in new products. We should be expecting efficiency, yes, but equally growth. And it should be fairly low risk, fairly low risk. Now, most companies, they kind of get this and they have the systems and processes in place. What's really interesting and what is frequently missing is this explore part. So the third how-to is you need to set up a separate business unit, different people, different guidance, different KPIs, different culture, different skill sets. It might even be a different building and a different cafeteria and different coffee machines altogether. Don't call it an ideation factory, but really call it a birthplace for new growth ventures. Here you should be exploring moonshots. That's what Google calls their most radical ideas. You should be doing disruptive business model innovation. You should be running radical experiments. You should be teaming up with very unlikely partners. You should be exploring new accelerator partners. You should be building early stage growth businesses, equally putting up a portfolio of 20, 30, 40 different, and run them as tests and experiments. Now, of course, like we talked about, you need buy-in from the board, you need resources in place, you need an innovation strategy in place. So there's a lot of stuff that needs to happen to make this possible. But you need all three of them. And you really need to draw a line between them so that you separate people from the core business from the growth business and the explore business. Last week in one of my sessions, we had a company come up and say, you know, we do all these, but all of our people are employed in that legacy core business, and they do the exploration part on their spare time. But they couldn't quite figure out why things weren't happening as fast as they'd like. Well, it was quite obvious. They spend about an hour and a half per week just looking into this. Unless you're able to separate these and dedicate time, it's going to be very, very, very challenging. And to show you an example from a Norwegian company, so this is what this example would look like if you put the oil and gas, now energy company Statoil. Statoil a couple of years ago said, you know, our long-term ambition is really shaping the future of energy. It became a call to action to expand the view on the company. It became a call to action to expand how people thought about the company. But the CEO, Mr. Eldar Sætre, was very, very focused on, we are first and foremost an oil and gas company. That is our core business. That's where we generate most of our cash flow. That's where we'll do most of our investments. But we also want to do other things. One of the things that was really important to the company was to develop a cleaner oil and gas industry. That became their second leg. Carbon capture storage, cleaner supply chains, new business models that allowed for cleaner profiles across of the company footprint. And they invested quite heavily in this. Now what's really interesting is what's happened around the explore part. that is now officially called the New Energy Solutions, where Statoil has been investing in offshore floating wind, they've been investing in solar energy, they've been investing in electric car charging infrastructure, they've been investing in advanced solar technologies. This would not have been possible if it had happened within the traditional core business. It's something the CEO says over and over again. Unless we had spun these out and separated them, it would have been very, very, very challenging. So if you're facing a challenging landscape, if you're facing declining core business, if you're facing new competitors, we really recommend develop 3 strategies, not just one. You have your core business strategy, you have your growth strategy, and you also have your exploration strategy. So how do we make this possible? Well, our recommendation, and we're going to spend the next 10 minutes on this, is you need to build a minimum innovation strategy. What I'm showing you now is what we call the MIS, the Minimum Innovation Strategy. It's a tool that we've developed in close collaboration with some of the early work we did with Cisco. It's built around a fairly well-known principle, build by partner, but we've expanded it significantly. And we're going to take you through this and hopefully give you enough insights that allow you to play around with this by yourself and bring this into your own work. Really, my goal here for the next 10 minutes is to give you a high-level introduction to the minimum innovation strategy so that you guys can start testing this by yourself in your own settings. And it starts with this. Any innovation that we do, any new business development, any new strategy should be built around market opportunities externally versus protect and defend the core business internally. Take the example of mobility. So we know that the mobility landscape is shifting quickly. Uber, Grab, a number of startups from the technology side to the platform side, to the UX side, to the infrastructure side are kind of joining the mobility space. So let's just take the space mobility. The first step here is, okay, we can do it ourselves. We see the market opportunity around mobility and we'll do it ourselves. Our employees, our engineers, will build it ourselves and the rest of you can just piss off and go away. And it might be a little bit unfair, but an example of that is actually Ford just a few years ago, where Ford was very happy with their innovation effort because their engineers had slightly changed the curve of the hood of this F-150, their best-selling truck. So a lot of the innovation that Ford brought to the table was really about designing a slightly angled hood. Not very radical, but that was what was important to them at the time. Now the other option is what we call buy. Buy is basically a full-on acquisition, a full M&A. So if we can't build it ourselves, we'll just go and buy somebody else that can. A good example of this is about a year ago when software company Intel or technology company Intel went to Israel and they paid 15 billion US to acquire Mobileye. And Mobileye had about 300-400 employees at the time, but they were recognized as the absolute leading company in the world when it came to the seeing technology for self-driving cars. Now, Intel have been trying to break into this space for quite some time, but they had not been very successful. So what they realized, we're not able to build it ourselves, we'll go out and we'll buy someone who can. Now the third leg here is, all right, let's partner up. Strategic partnerships, that is the way to go. We'll combine some of our people and we'll go out and find a few partners. And this is a good example. This is, of course, the Volvo working very closely with Uber. Uber has been testing their self-driving technologies on top of the Volvo platform for a few years now. This relationship has actually grown to the stage where Uber recently signed 20,000 car order to have delivered by Volvo over the next couple of months and years. Now, this was initially a very good partnership because it allowed both Uber and Volvo to learn. And I think that right about now, Volvo is starting to realize that, this is not as attractive anymore because Uber has the customer relationship, Uber owns the client data, Uber, not Volvo, is really benefiting from this strategic partnership. Now, the fourth leg here is, all right, well, the future is very uncertain. We don't know what's going to happen. We don't know what it's going to look like in the future. We don't know which technology is going to emerge to win. We don't know which platforms are going to emerge to win. So we invest in a very broad portfolio of startups. Instead of betting on one startup, we invest in many. And interestingly, right now in the mobility space, we are keeping a close eye on about 1,700 startups up to a few years old at different places in the industry landscape for mobility. Some of them are mobility ecosystems, some of them are platforms, some of them focus on the connected cars, some of them focus on sensors, some of them focus on electric vehicles only. More than 1,500 companies now are actively shaping next generation thinking around mobility. If you expand and you take up all of the emerging ones, large number coming out of China notably, you'll probably be able to identify between 3,000 and 5,000 companies that you should be watching closely around disrupting the mobility landscape. And that's a big task for any company. Fifth leg, and the final leg here to start being able to build your minimum innovation strategy is co-developing accelerator programs. So this is quite new to a large number of companies. This requires you to partner with the likes of 500 startups, so 500 durians in Southeast Asia, with hacks, with Startup Bootcamp, and run global accelerator programs on challenges you're not able to solve yourself. So what you're seeing here is a pretty interesting example of such a co-developed global accelerator program between Airbus, which of course is German-based, and HAX. Now, HAX is a American-run, Chinese-based hardware accelerator in Shenzhen, China. Shenzhen has recently surpassed Hong Kong in terms of economic output. It has been called the next Silicon Valley, or sometimes the Silicon Valley of the East. Well, what's interesting here is that Airbus, with its significant innovation funding and significant innovation capabilities back in Europe, has chosen to experiment with the Urban Air Mobility Accelerator Program, or Flying Car, in Shenzhen. This is probably not something that Airbus would have done a few years ago, but we're seeing that Airbus is shifting from a will innovate internally and much more open. Now, this means that companies are moving from a very closed innovation logic more towards an open innovation logic, and then of course finally towards what is emerging that we call the networked innovation logic. Now, the networked innovation logic is poorly understood. It is not well documented, but it basically forces you to open up some of your key challenges, open up some of your key aspirations, explore partnerships that you wouldn't even have considered just a few years ago, and test innovation strategies much faster, much more agile than you would have. And there's a couple of books on this that I really want to recommend, both by Henry Chesborough, professor at Berkeley. One is Open Business Models, How to Thrive in the New Innovation Landscape, and the other is the Open Services Innovation. They're both really relevant books. So if your company is kind of trying to move from a closed innovation logic to much more of an open networked innovation logic, these two books are really relevant examples. So how do you bring this back? Well, this is where the minimum innovation strategy is really simple to use, easy to understand, but quite complex in content tool to use. On the upper left-hand side, you have 3 questions that covers the things that we talked about right now. Industry shifts outlook, market opportunities, and resource allocation. It comes to resource allocation back again. But then you dive into the 5 pillars. Should we build ourselves? Should we buy? Should we partner? Should we co-invest? Or should we co-develop? Now, for most companies, this is fairly easy to grasp. We understand it intellectually. But diving into it and start discussing what does it mean to us, that's a real challenge. Now notice, I'm going to get my pen here. Now notice what we've done in these areas. Here we have priority, key programs in place. Let me get that a little bit closer to the screen here. There we go. Our biggest need, key capabilities that we should develop, and next action. So these questions on the lower left of the screen, that's really where you can have useful information and useful discussion. What we've seen testing this and implementing this in a few organizations recently is that these are incredibly challenging questions to discuss. For most companies, let's just say the partner side, so right here. How strong a priority is partnering with new, unlikely partners? What do we need? What is our biggest need? Well, that by itself is a huge discussion. What kind of capabilities should we develop? Again, if your company is fairly new to this, that's a big question. And then, of course, which action steps do we take? Working through the build, the buy, the partner, the co-invest, and finally the co-develop allows you to build a very complex innovation strategy, but with a minimum effort. We have seen companies that could take months to develop the understanding, but in half a day you can really build a minimum innovation strategy with the right people in the room. We're not saying innovation is easy. We're not saying this tool has all the answers. But we do firmly believe that by building simple visual tools, you can significantly simplify and help speed up how your company or how your management team works on and understands innovation. So let me wrap up this initial webinar with just a few quick comments. And I'll be very happy to take any questions, any Q&A, any comments that you might have in the chat box or on social media. The 5 strategy traps that we see. Number 1, it starts with the board. You need to find ways, creative ways, different ways to involve the board in your process. If you spend too much time coming up with the perfect strategy or a fairly disruptive strategy, you're almost guaranteed that the board will nix it. Don't run the risk of posting ambitious ideas unless you've already prepped this and already gotten the okay from the board. Item number 2, a resource allocation. Resource allocation is challenging. Rita McGrath over at Columbia has a great book on this, where really the resource allocation process is the essence. But it comes down to shifting small resources, and this is equally valid. We're getting a question here from a listener with the hand of Gudula. I was wondering if you ever did innovation with small companies who do not have the resources to buy other companies, or even just to create a new business unit. No, that's a great question. It feeds perfectly into the resource allocation challenge, where we have to find ways of allocating perhaps just small funds, time, people, diverted away from operational sides, diverted away from the maybe the old sides, and shifted slowly over to new and emerging possibilities. Now, this is challenging, but we've seen this work with large companies, small companies, startups. A couple of years ago, we worked extensively with the IT software company that had about 27 employees, and the way that they were able to do this was they took one evening every 2 weeks where they worked only on new business opportunities, and eventually developed some quite radical new business models. So it is possible as long as you stay focused on shifting resource allocation. Equally for not having enough time for innovation, no time, no interest. We need to be able to help management and find time to make this happen. Number 4, the fourth trap of 2018 is really, do we understand the shifting landscape? The landscape for most companies is shifting much faster than they expect. So if you've been doing your competitor analysis now quite similarly for the last couple of years, there's a fair chance that if you rinse and repeat, you're going to miss what's really happening. But the final and obviously the most important that we see is, if you're facing significant changes or a new industry landscape, you need to have not just one but multiple strategies and multiple business models running in parallel. This is challenging for big companies, small companies, but it's really the only way to stay ahead of the trends that's happening. Those are, if you will, the 5 strategy traps for 2018. This has been our first webinar. It's a platform that we're testing out. I hope you've been able to listen in. I hope you've been able to watch. And if you've enjoyed this, I would love to welcome you to sign up for our next webinar. It's a week and a half from now, March 14th, and we're going to focus on the 4 roles of the strategy officer. So my name is Chris. We are about 30 seconds away from closing. I want to thank you for your attention. I want to thank you for the time. And we'll be happy to keep your dialogue and keep this discussion going and see how we can make this better. So thank you for tuning in and have a good afternoon.